Welcome to Clara's Real Estate Podcast, your source for smart real estate tips. Let's get started.
Welcome to the debate. When we think of a financial portfolio, we usually picture, a dashboard. Clean numbers, percentages, green and red arrows. It is wonderfully sterile. You can liquidate a stock position with the click of a button, and the cash is sitting securely in your account by tomorrow morning.
Right. It's the ultimate frictionless environment. Just a perfectly liquid reality where your assets are, abstracted into pure data.
Exactly. But today we're looking at what happens when you try to treat a physical house like a stock on a dashboard. We are stepping into the messy world of real estate, specifically the highly localized, fiercely competitive 2026 market on Long Island.
Oh, it is a very specific beast right now.
It really is. We are analyzing the recently published 2026 Sell versus Rents Guide to answer one massive question facing homeowners in Suffolk, Nassau, and Queens. Basically, when you are transitioning to your next home, is it financially and strategically superior to cash out at peak market value, or should you hold on to that property to capture a steady stream of passive income and long-term equity growth?
Yeah, it's the classic dilemma for anyone moving on to a new phase of life. Do you take the money and run, or do you plant a flag and try to build an empire?
Well, I'll be arguing that taking the money and running, selling to capture peak market value, is fundamentally the optimal path. By cashing out, a homeowner minimizes their exposure to the notoriously heavy local tax burdens of Long Island, and, frankly, completely sidesteps the grueling reality of property management. It is a play for financial certainty, absolute liquidity, and peace of mind.
And I will be taking the opposing view today. I'd argue that the rental strategy mathematically outpaces a single cash out. By utilizing the incredibly strong local rental rates we are seeing in 2026, a homeowner can build long-term equity and generate steady income. Look, real estate is a wealth engine, and turning it off prematurely just to get a lump sum of cash is, it's a missed opportunity.
I get the appeal of the wealth engine idea. I do. But let's lay out the mechanics of that certainty I'm advocating for. From my perspective, when you decide to sell at peak market value, which we are currently seeing across these 3 counties, you do something incredibly powerful.
Which is what, exactly?
You eliminate the debt you still owe on the house instantly. You are permanently freed from the massive property tax bills that define the region. You take your wealth out of the messy physical realm and put it back onto that sterile, manageable dashboard where you can actually diversify it.
Okay, I understand the appeal of that cleanliness, but I look at it through the lens of long-term wealth generation. You shouldn't view real estate as just a piggy bank that you smash open the second you need liquidity.
A very expensive piggy bank.
Right, but when you rent out a property in a high-demand area like Queens or Nassau, you are effectively outsourcing your debt. You are hiring a tenant to pay off your mortgage while you keep the underlying asset.
Wait, let me challenge that idea of outsourcing your debt. Because honestly, it ignores the concept of trapped capital.
How so?
Let's say you have a home in Nassau County and you have, $500,000 in equity sitting in it. If you keep the house to rent it out, that $500,000 is doing absolutely nothing for you in terms of agility.
Well, it's appreciating.
On paper, maybe. But it is trapped in a single, hyper-localized asset with an outstanding mortgage balance. If you liquidate at peak value, you secure those net proceeds immediately. You can put that capital into index funds, municipal bonds, or, other vehicles that don't require you to fix a boiler. The financial certainty of taking your chips off the table when the market is hot is just hard to beat.
I see why you think that, but let me give you a different perspective on liquidity. You're assuming those alternative investments will outpace the leveraged return of real estate. And that brings us to the core mechanism of why renting builds so much wealth, which is leverage and inflation.
Okay. Walk me through how you see that playing out.
Real estate is one of the only asset classes where everyday people can control a massive asset with a relatively small amount of their own money. Let's say your property is worth $800,000. If you sell and take your equity, you are now only earning returns on that equity.
Right, your raw net proceeds.
Exactly. But if you hold the property, you are earning appreciation on the entire $800,000 asset, even though the bank still owns a chunk of it. Add to that the fact that inflation is actively eroding the real value of your mortgage debt, while your tenant's rent payments are covering the interest and principal.
So you're banking on multiple economic forces aligning perfectly.
It's historical precedence. You have inflation eating your debt, a tenant paying your bills, and an asset growing in value. If you sell, you get a lump sum, sure, but you kill that dual engine of wealth creation.
That is a very elegant mathematical model, I'll give you that. But that equity growth doesn't happen in a vacuum. It happens in New York, which means we have to talk about the silent partner in every real estate transaction here.
You're talking about the county tax assessor?
Yes, the county tax assessor. Property taxes on Long Island aren't just a fee. They are a silent co-owner of your house that demands a bigger cut every single year. We're talking about some of the highest municipal tax burdens in the entire country.
They are definitely up there.
Right. So when you sell the property, you sever this ongoing tax burden completely. But when you choose to rent, you leave yourself entirely exposed to yearly tax obligations that are virtually guaranteed to rise. That can severely compress your profit margins and turn your so-called wealth engine into a massive liability.
I'm sorry, but I just don't buy that. Let me tell you why. You are looking at taxes through the lens of a primary homeowner, where it feels like this unrecoverable loss. But in a rental scenario, the financial structure changes entirely.
It's still money leaving your pocket.
No, not exactly. When you transition from a residence to a rental property, the local tax bill is no longer a personal burden. It becomes an operational expense of the business.
An expense that still has to be paid out of the revenue generated by the house.
Yes, but who ultimately pays it? The consumer, the tenant. The passive income generated by current county rental comps is more than sufficient to offset the property tax bill. In high-demand areas like Nassau and Suffolk, rental prices have adjusted upward precisely because the cost of homeownership, including taxes, has risen. The market absorbs the tax.
That assumes a lot of perfectly cooperative variables.
Plus, as an investor, you unlock tax advantages that regular homeowners just don't get, like depreciation, which can significantly offset the income you're bringing in.
Look, I see why you frame it as a simple operational expense, but I think that assumes a perfectly frictionless market. You're assuming 100% occupancy rate with perfect tenants who never default. You're also assuming that rental rate increases will perfectly mirror the aggressive tax assessments typical of Long Island municipalities.
But the demand right now is incredibly inelastic. There's a severe housing shortage.
True, but let's look at the actual mechanics of local government. Say a school district in Suffolk County votes to build a new facility and increase the budget. Your property tax might spike by 8% in a single year. You cannot always pass an 8% rent hike onto a tenant who is already stretched thin, especially when you factor in local regulations.
The market rate is the market rate.
But when that margin compresses, when the tax goes up but the rent can't, it is the homeowner's equity that bleeds to cover the spread. The operational reality makes renting a highly precarious financial tightrope.
It's only a tightrope if you don't do the math beforehand. Landlords right now possess significant pricing power. Viewing the tax burden as a fatal flaw completely ignores the fundamental supply and demand mechanics operating in Queens, Nassau, and Suffolk in 2026. People need places to live, and the barrier to entry for buying is historically high, which keeps the rental pool deep and competitive.
I hear your spreadsheet math, I really do. But spreadsheets don't call you at 2 in the morning on Thanksgiving because the basement is flooding in Suffolk County.
Fair point.
We have to pivot to the human element here, the lifestyle implications, because the term passive income is arguably the biggest myth in real estate.
Okay, I will grant you that passive is a widely misunderstood term in this context.
It is a complete misnomer. When you factor in the realities of landlord responsibilities, there is absolutely nothing passive about it. A homeowner's comfort level with being a landlord is almost always overestimated. We are talking about managing tenants, dealing with late payments, coordinating contractors for emergency repairs, and navigating the incredibly complex labyrinth of New York State housing regulations.
The regulations are strict, yes, but they establish clear rules of engagement.
They also establish immense risk for the property owner. Let's talk about the mechanics of those regulations.
If a tenant stops paying rent, New York eviction delays can stretch from months, sometimes over a year.
That is the extreme worst-case scenario.
But it happens. And during that entire period, your wealth engine is generating zero revenue, but your mortgage lender and the county tax assessor still expect to be paid on the first of the month. You could literally be floating two mortgages, your new home and your rental, out of pocket.
Which is why you screen your tenants rigorously.
Even with good screening, life happens. The lifestyle implications of managing a property in Queens or Nassau, especially if the homeowner has moved out of state, can severely degrade the perceived financial value of the rental income. You might be making an extra $500 a month on paper, but if you are spending 10 hours a month dealing with the dispute over a security deposit, your hourly rate is abysmal.
That's a compelling argument. But have you considered that the labor and the friction involved are explicitly compensated for by the long-term equity growth? I concede that landlording requires effort. It is not clipping coupons.
Not at all.
But the lifestyle implications are a known variable. They can be managed, they can be outsourced to a property management company, or they can simply be absorbed as the premium you pay to hold a high-performing asset.
But outsourcing comes at a steep cost.
It does, but you're trading some lifestyle friction for what is historically the most reliable path to generational wealth. The broken boiler at 2 in the morning is a nuisance, absolutely. But 5 years later, when the property has appreciated by another $150,000 and your tenant has paid down $50,000 of your loan, that nuisance seems like a fairly small price to pay.
I'm not convinced by that line of reasoning because it dramatically underestimates the psychological toll of property management, and it glosses over the true cost of outsourcing. Think about a family transitioning to a new phase of life. Maybe they are retiring. Maybe they are relocating for a new career. Carrying the emotional and administrative weight of their former Long Island home is a massive anchor. You mentioned property management companies. Sure, you can hire one, but they typically take 8 to 12% of the gross monthly rent, plus placing fees for new tenants.
Which is a deductible business expense.
But a deductible expense that still drains your cash flow. Let's do the actual net proceeds analysis here. When you subtract a 10% management fee, subtract the high Long Island property taxes, subtract insurance, and hold back 10% for a maintenance reserve, your so-called passive income stream is barely a trickle. The net proceeds of a clean sale invested in a truly passive index fund offer comparable historical returns without a single midnight phone call or the risk of a tenant defaulting.
But the index fund does not offer leverage. That's the missing piece in your math. If you put $400,000 in an index fund, you are getting returns on $400,000. If you keep an $800,000 house, you are getting returns on $800,000. That multiplier effect is the whole point.
Assuming it consistently appreciates.
Right. However, I will concede this. Because individual comfort levels with landlord responsibilities vary so wildly, and because the specific financial variables are entirely unique to each individual, generalized advice is highly dangerous here.
On that, we are in complete agreement. We can debate the macroeconomic theory all day, but at the end of the day, real estate is fiercely local. You cannot make this decision based on a national news headline or some generic financial blog.
Exactly. And this is where the source material introduces a really crucial concept, which is the necessity of professional valuation. The guide actually uses a case study of a pricing strategy advisor or PSA-certified real estate agent named Clara to illustrate this exact point. It highlights an interesting gap in how lay people value real estate versus how the math actually works.
Right. Because lay people look at top-line revenue. They pull up a website, see that a house 3 towns over rented for $4,000, and they just assume that's their cash flow.
Precisely. They do the math on a napkin. But the methodology this case study presents is a strict, comprehensive net proceeds analysis. A PSA-certified expert like Clara doesn't just look at gross rent. They evaluate the exact rental comparables in your specific neighborhood against the projected selling price of your home in its current condition. I'd argue that only by using this kind of rigorous, hyper-local methodology can a homeowner actually prove if the rental model works mathematically for their specific property.
That is a crucial distinction. Because every homeowner's financial landscape is unique, hyper-local data is the only objective tiebreaker. The text points out that these advisors offer these analyses often as free, no-obligation consultations because the variables are just too complex to guess.
You can't just eyeball it.
Exactly. You might think your house in Suffolk County will rent for $3,800 a month, but an expert analyzing the localized saturation might tell you it will realistically command $3,100. That $700 difference completely flips the math on whether you should hold or sell.
It absolutely does. And it's not just about the gross rent. A true net proceeds analysis integrates the specific outstanding mortgage balance you still owe on the house, the exact municipal tax rate for your specific school district, and realistic maintenance caps based on the age of your home. Selling price at this specific moment in 2026 yields enough trapped capital to justify the sale, or if the local rental market is strong enough to carry your operational expenses and generate true, meaningful passive income.
Which brings us to the reality that guessing is essentially a massive, unforced error when dealing with hundreds of thousands of dollars. You need someone who understands the micro-market dynamics of Long Island to run those numbers. It is the only way a homeowner can make an informed, confident decision about whether to cash out or hold.
Because the levers of wealth in real estate, taxes, leverage, maintenance, and local demand are constantly shifting, you need to know exactly where they sit for your specific address today.
Well, this leads us to where we must synthesize these viewpoints. We have covered significant ground today regarding the 2026 Long Island real estate market. To summarize my position, I maintain that cashing out at peak market value prioritizes financial certainty and lifestyle freedom. By selling, you instantly eliminate your remaining loan. You cut all ties with the heavy property tax burdens of Suffolk, Nassau, and Queens, and you secure your wealth without ever having to endure the intense responsibilities and risks of New York landlord laws.
And my position remains that renting embraces that manageable friction in exchange for something much more powerful, which is long-term equity growth and leverage. By treating the tax bill as an operational business expense covered by current strong tenant demand, you allow an appreciating asset to continuously build your net worth over time while someone else pays down your debt.
Yet, despite our different fundamental philosophies on the time value of money and lifestyle preservation, I think we have arrived at a very clear point of convergence. There is no universal one-size-fits-all correct choice here.
Absolutely not. Ultimately, the right choice comes down to your unique personal situation. It hinges on 3 specific variables: the exact debt you still owe on the house, your specific local property tax bill, and your deeply personal comfort level with the realities of being a landlord.
Navigating these scenarios requires evaluating projected selling prices against hyperlocal rental comparables. Listeners navigating this transition in the Long Island market have much more to explore in the material, particularly regarding how their own unique financial landscapes interact with these economic principles.
It is a complex puzzle, and every single piece has to fit your specific life stage and risk tolerance.
Indeed. At the beginning of our discussion, we talked about a physical house being like a massive, heavy vault compared to the liquid, easy-to-read dashboard of a stock portfolio. The ultimate question isn't whether the vault is heavy. We both agree that it is.
It's very heavy.
The real question is whether the treasure growing inside that vault over the next decade is worth the heavy lifting required to keep it, or if it is finally time to unlock the door, take your wealth, and walk away, light and unburdened. That is something only you and the raw data of your specific local market can decide.